All right. Thank you, everybody, for joining our Landowner Insights webinar here for July. We've got a really interesting topic and a great group of guests to help us dive into that here this month. So we're going to talk about the tax benefits of farmland ownership. And of course, this is at the forefront here, given the fact that the One Big Beautiful Bill is recently passed. But we're continuing to see kind of a shift in the capital that's interested in farmland, moving to that kind of high net worth family office, more legacy ownership kind of dynamic, and really characterizing the various tax benefits that we have at our fingertips is becoming really important to us. So quick run through our guests. We've got Tyler Bruch, CEO and founder of Boa Safra, a company that really focuses on the Section 180 excess fertility deductions. And Tyler's also a farmer that has land all over the place. I think you're centered in Nebraska is home for you, right, Tyler?
That's correct. Yep.
Yeah, so this is going to be really interesting. It's a really powerful tool from a tax benefit standpoint that is growing in use, and it's pretty impactful. We'll run through that. We've got Liz Krause, a CPA with McGowan, Hurst, Clark, and Smith. I always have to look at the names in order to get that right. And Liz is a senior manager. And Liz, you've worked with us trying to capture the right tax management of assets all over the country. I'm sure that's been interesting.
It's been a lot. I've learned a lot and I met a bunch of cool people through the process. So I love working with you guys.
And then we've got Paul Neiffer, the editor-chief owner of FarmCPAReport.com, and also a regular contributor to Top Producer Magazine. And Paul, you tend to find yourself hitting a lot of these webinars across the landscape.
You could safely say that. Matter of fact, I'll be in Des Moines tomorrow and Thursday speaking, but that's in person. So
Perfect. I think we've found ourselves on the stage together a few times as well.
we have.
So a quick overview on how we're going to break this down. And we're going to have to move pretty quickly through these topics just because there's so much here, right? This is really rich. There's a lot of details that we can dig into. And for the folks listening, you're going to get a lot of numbers. You're going to get a lot of sort of detailed information about how these things break down. We are planning to put together a little bit of a white paper as a follow-up to this webinar, engaging this whole group, where we'll walk through some case studies and we'll try and get this characterized in a way that is useful to sort of leverage. And hopefully we can get that put together here over the coming weeks and publish for folks to be able to reference back. So don't worry about necessarily capturing every detail that we're going to go through, but we really want a discussion and we want to get some of the anecdotal information and stories on how we've taken advantage and how we're seeing some of these things work over time. So we'll start out working with Tyler on the Section 180 and really characterize how that works, what it is, what's the history, and a little bit of what he sees across the marketplace. Liz is going to lead us in a discussion on the depreciation side. And this is pretty intense in terms of how many rules and regs and making sure that we're parsing those opportunities correctly. And then Paul's going to give us some backstop on what's happening with stepped up basis and how do we think about that, as well as the 45Z tax credit. And then we'll talk just a little bit about what we're hearing about Opportunity Zone 2.0. That's a pretty interesting opportunity. We'll admit that we're kind of on the front edge of really dissecting how that's going to look. And there's a lot of details that still need to be flushed out. Zones are going to be redrawn. We'll get into that just a little bit. And then, of course, there's a cross-cutting theme through all of this that really hits what came out in the One Big Beautiful Bill. And we'll kind of pick on those components of what's happening as we go through these different topics. So, Tyler, let's start out. Let's talk about the legacy or excess fertility deduction, the Section 180. Give us a little background on what it is and how it works.
Well, thanks, Dave, and everyone. First of all, we're not talking about something new. We're talking about something that's extremely old, that's been around since 1960. What's new is there really has never been a reporting system or a documentation system to gather all the data and put it in a package in a way in which a client could utilize it, and then which a CPA could take and digest that information and have the proper documentation needed to be able to help their clients take advantage of it. So what Boa Safra does in a nutshell is does all that fact finding, gathering information through soil testing to gather what those nutrient levels are, and then break down how many pounds of nutrients are there, what the price per pound of those nutrients are, what removal rates are, what excessive fertility rates or values are. And all of that data documentation gets buttoned up in a very concise report that comes to the client and then effectively the client's CPA, in which you're able to utilize that deduction. And you really have Section 180 gets a lot of the hype and glory because that's where it was truly designed for the landowner to take advantage of that deduction if he was engaged in the business of farming. Much like what Liz will probably talk on with Section 179 and bonus depreciation, it almost works the same way. The asset was acquired, and the year the asset was acquired, that fertility value could be written off 100% in the year that asset was acquired. And there's a lot of folks that take advantage of legacy nutrient deductions, also not as direct farmers, but maybe as somebody that is buying land as an investor or other ways where they're not actively engaged in farming, but they're just, they're receiving cash rent, for example. And typically those fall under different codes, Section 167, 168, or 611 under depletion deduction, which essentially just means that deduction is getting used, but it's getting amortized over a longer window, typically 3 to 7 years. So there's two ways in which the deduction gets used, either all in one shot or amortized over time. But I think the important thing is when we look at farmland, for a long time, most folks didn't realize you could be taking a deduction against the fertility in the soil itself. And now that, we've been on the forefront of trying to educate the market in a sense to help them understand that, people are starting to adapt to it more and more. It's becoming a little bit more mainstream. And the benefits are pretty staggering. Dave, you wanted to go through an example perhaps on a property and a value. I think that'll be helpful to really put it in context of what it means when looking at a parcel of ground.
Yeah, so we're going to have as we go through a couple of these elements, just to call it a generic Iowa 160 acres. Let's say it's bought for $12,000 an acre. So our basis into this thing is 1.92 million. Okay, and the Section 180, if we come in as the first step, and your average, Tyler, call it in the aggregate, what, $1,700 an acre? I think you guys kind of put out there.
That's a fair number for Iowa. Yep.
So that'll create $272,000 worth of deduction, which right out of the gate is a little over 14% of your basis into the farm that you can deduct from future income. And go ahead.
Yeah, and Dave, that's perfect. And I would just like to say, if you take that 272 and take it times, let's say, an effective 40% tax bracket by the landowner, that turns into a $108,000 cash, essentially savings per acre on that asset, or roughly $680 an acre. And when you break that down from the investor side of looking at it to a cap rate return, you effectively put about a 5.6% cap rate return on your investment within 60 days of purchasing it by just taking advantage of the tax code and the deduction that allows you to do it. And if you think about the cost of $40 per acre, the service fee to do all that work, that's a 17-to-1 return on that $40 cost. There's not a lot of things in ag we can do to generate 17-to-1 returns. So that's where I think it's starting to be more of a popular deduction and tool for folks to use, because it is a pretty big one-time hit.
Yeah, so that was one of the questions, and you just put it out there. So your guys' cost for doing the analysis and having a report come out that's ready for the accountants is $40 an acre.
Yeah, and that includes the soil sampling. Our team, we test to our protocols, which is a set that we've determined is acceptable by the IRS, in a sense, by what we have to do. And then in the case that we need support through that, CPA support, et cetera, that is provided as well. So we try to really offer a white glove service for the client and make that as simple as possible for them. And it's just, farmers sometimes don't love paperwork and they don't love doing some of that stuff. We've tried to make that really easy in that regard. So it's really get that inbound data, and then we will carry the stick until we get to the end of the process for them.
Tyler, you
So-
can eliminate the word sometimes. They don't like doing paperwork,
Okay.
period. So
All right.
let's
Hey,
let's
I've got my
eliminate
own
that word
hand up because
sometimes.
I farm. I don't like doing paperwork either, but it's part of it.
Fair point. So, obviously we're working on this with clients that we have that are buying farms. I've done it on personal farms and Liz has helped out there. The ideal is to come and get this done right when you buy a farm, but give us a little bit of a sense of what the opportunity is for somebody that's maybe owned a farm for a few years. How can somebody that's been in an asset for a little while take advantage of it?
Yeah, that's a great question, and I'm glad you brought it up. I mean, there is the ability, and we do a lot of work in which doesn't happen in the current year the asset was acquired, and it's effectively a form of hindcasting or a forensic agronomy. So everybody knows today when you buy a farm, typically you get a soil sample, then you make a prescription for the next 4 or 5 years on what you plan to grow and what fertility it will take to grow those crops. Effectively, what we do is do that exact same math, except we just do it in reverse. We look at what has been grown and what it took to grow those crops, and we can do a plus minus calculation against what the current soil tests are to determine with extremely close accuracy. And the reason we know that is we've taken soil tests from 10 years ago and we've done our methodology from current day going in backwards, and we get within a couple percent of what that looks like just by kind of that hindcasting model. So that does allow somebody to be able to take advantage of this when they've already owned an asset. And I think the important thing that is all farmers, and I'll raise my hand, don't enjoy paying taxes. And a lot of times we go and do things in December and we buy a bunch of things at John Deere, or we prepay, or we defer income because we don't want to pay taxes, right? We don't want to send a check in. Well, here's the ability to take at $40 an acre and get that same big value in deductions on assets we've already owned without going and spending a bunch of money on a tractor we don't particularly need that's going to have a depreciating value, the time we drive it off the lot. This is something that really does help those guys take advantage of something at a much lower cost basis to defer that income or that tax liability.
So, question for you guys, Liz and Paula. You've both worked on the tax accounting side, leveraging Section 180 and the various other elements of the code that Tyler talked about. If it's an LLC, a passive owner, etc. Right off the bat, where it's not new, but in some ways it might feel like it. Have you ever seen where you get some pressure or trouble from the IRS in leveraging this deduction?
I've talked to Paul about this. Actually, this was a question I had from him. Him and I connected last summer on this. And, I think the biggest thing any CPA is going to tell you is, do you have documentation, right? Boa Safra provides a really nice report, lists everything out. If you do get audited, that's the biggest thing is having that actual support and documentation. I know Paul has some more insight on that as well.
Yeah, I think mostly what I've seen is you almost end up training the auditor. Sometimes they'll get a return that this wasn't even the issue, but it sort of comes up as sort of an ancillary issue. And then you just train them as to what the deduction is and what the guidance is from the IRS, because there is some guidance from the IRS. And typically that resolves the issue.
So the technical and regulatory basis is sound. You guys there's just not a problem. It's really more to Tyler's point of folks taking advantage of it versus being some newfangled toy in the toy box.
Yeah, because the guidance we have is now almost 35 years old. Now it's not, I will admit, it's not a lot of guidance, but it is good guidance. And essentially Boa Safra and others has sort of taken that guidance and they produce a report to back up based on what the IRS wants them to do.
So Tyler, kind of closing this one out, we've had some questions from some of our investors at family offices that we work with. Hey, how do I target farms that actually are going to have a high Section 180? And the short answer is you're not going to have a perfect sort of analytical basis to do that. You certainly can get some information, but I would imagine farms that get a lot of manure from a fertility standpoint probably stand out a little bit. Are there particular sort of regional differences that you guys have seen relative to soil type changes across the country and production system changes? Maybe a little feedback there.
Yeah, there's probably the biggest misconception is sometimes people think because farm ground costs $20,000 an acre, the number is going to be really, really inflated. And that really, to my surprise as well, is not always the case. What I think if I were looking at this from an investor standpoint, the $20,000 acre Iowa farm ground, we're using 12 in our example. So I'll go back to that. You're looking at roughly a 14% deduction from your basis at this type of value. But when you go now and take that same deduction of $1,700, which is kind of a national average number, a safe number to look, and now you go find a farm that costs $5,000 an acre, now your percentage of deduction in terms of asset is much higher, right? So we find a lot of folks that are like, hey, I'm not necessarily maybe looking for the $20,000 an acre farm ground, but knowing that this tool exists, that $4, $5, $6, $7, $8,000 farm ground is kind of a bigger bang for my dollar when I look at it from kind of a tax liability offset. And that was a surprise to us going into it. So looking at kind of how we've mapped that out a little bit, often we'll have folks that say, hey, I haven't bought this farm yet, but I'm really interested. Could you give me some insight on what you think it may be? And we've compiled enough data with doing over 7,000 of these we're now in all 50 states. We can give people a pretty good idea, hey, what this county is going to look like in the state, which is helpful for them to make some kind of game time decisions.
What's the biggest number you found? You got to tell us.
The biggest one was a farm that had 20 years of cattle manure on it, and that was about $3,500 an acre, and it was just excessively high. Now, the lowest number you may ask that we have found was $700, and that was on something that was pure white sand in Florida that got about 80 inches of rainfall a year. So it is regionality, and there are different areas. Weather, obviously, and crop and all those things play a difference, but 700 to 3,500. But it is really a true mid $1,500 to $1,800 range.
Perfect. That's super helpful. I think, Liz, let's hop over and dive into the depreciation conversation. And of course, the rules and regs and IRS structures here are pretty complicated. I think you may have some tables that can help navigate us through a little bit on how we can take advantage of this in farmland and what it looks like.
I do. I will share my screen on that. Thought I'd put together a little presentation for everybody to follow through. As there are quite a few rules here. I just wanted to lay this out. So I think the first question I sometimes get, can I depreciate the land when I buy land? And the answer is no. Land you kind of want to consider is really that canvas, right? It's never going away. It's a non-wasting asset. That's truly just your basis, right? Think of that as your starting point. Now, as you make different improvements or buildings, to that land, those are things, you can take a tax benefit for. For example, we look at drainage tile, that's something, that's commonly asked, a 15-year life. So you have the option to either take that over 15 years, or you can go ahead and use Section 179 or bonus, depending on your tax situation, to write everything off in year one. Probably touch on this, at the end, but the Big Beautiful Bill did take bonus back to 100% for 2025, which I know is a huge lingering question, and a lot of concerns, that taxpayers and business owners have.
Let's be careful. If it was placed in service between January 1st and
Yes.
January 19th, it's 40%. So
that is correct, Paul.
yeah,
So hopefully no one bought anything in that first 19 days of the year.
Well, and it wasn't really in service, it was still being
Correct.
repaired. So yes.
Yep. So yes, thank you for that. Then we look at irrigation pivots and wells. Two different things. A lot of times I think if it's above ground, you're thinking of it as equipment. That's a 7-year life. Those wells below ground, part of the land, you think of that as a 15-year life. As long as that's not part of a building, right? You're truly thinking of that as a standalone asset. Then you kind of get into some more, I would say, muddier things, land excavation, tree clearing, dirt work. You're kind of thinking, okay, well, that's land though, right? Can I depreciate that or write that off? It kind of really truly depends. What are you doing to the land, right? Are you really getting the land ready for something. Tree clearing, are you clearing off a timber to build, some grain bins? Then you're going to capitalize that. It kind of really depends. Truly, are you making a repair? Is it temporary? Is it cleanup? Or is it truly, enhancing the land? Is it permanent? So those bottom three really you have to take into consideration and talk to your CPA about what you're actually doing to that ground. Look at buildings and structures. This is another question I get. The agricultural area has a very unique 20-year life for buildings. And again, all of this is eligible for bonus depreciation that you'll see on this page or Section 179 on the left-hand side. Farm buildings, you're really thinking about, your barns, equipment sheds. The first kind of three, same thing, hog confinements, poultry barns, even, dairy producers. So you really can kind of get anything in there. Shops, you have your shops on the farm, hay buildings, any sort of that stuff really falls in that 20-year, bucket that you see in those top three. Grain bins and fences are both 7 years. Those are pretty straightforward. And then if you happen to buy, let's say a 100-acre farm and there's a little 5 acres that is kind of, carved out for residential, and you say you rent out that house, that residential piece does have a little bit different rules. You have to carve that out at 27 and a half years. Treat it a little differently. You cannot write off that house in year one. That is something you do have to take over, 27 and a half years. With that, a lot of the times people will get appraisals. With the appraisal will break out, for example, the grain bins, farm buildings, a residential building. If you are buying something that's just not farm ground and may have some other buildings on it. Because that's kind of a question I'll see is like, okay, well, I bought this farm, but it has, 2 grain bins and then a house. What do I do with this, right? So we do need to make sure we carve those out. That's something to talk to your CPA about is, how do I do that? And then, I've mentioned 179 and bonus. That will come up all day, I think. Just kind of something to mention. Section 179 and bonus, both are methods to accelerate depreciation to its fullest in year one. I would say I most of the time see people do bonus depreciation. There's no limits, no phase outs. You can create a net operating loss. It applies to all sorts of property outside of real estate, residential real estate. Section 179 does have some limitations, so some people don't use it for that. But otherwise, both of them, are both beneficial. Something again, just to talk to your CPA about to see if one is better than the other.
Liz, we probably should, on the Section 179, I thought it was going to be next year, but it's actually for this year. They did bump it to 2.5 million, and the phase out starts at 4 million. So
Okay, perfect.
that's effective for taxable years beginning after December 31 of 24. So that is a benefit.
Yes. Something I
So
can...
Liz,
Yep.
one of the common ones that we'll see, particularly in the Midwest, east of the Missouri River, when we're acquiring assets, a lot of farms that we may acquire for a client will already have that pattern tile, or they may want to come in and actually run that pattern tile as part of the acquisition, right? And they can capitalize that up front at the acquisition as a reserve, et cetera. We might structure that different ways. What would be the differences on those two scenarios in terms of the tax handling?
Yeah, buying that versus inputting it yourself.
Yep.
So if you're, you buy the farm and you go ahead and do that tiling work, I know an example we had is, let's say it's 160 acres, $1,500 an acre of that tillage work. You're looking at a $200,000, dollar deduction, give or take, close to 250. Again, that's a 15-year life. So you have the option to take that maybe like, $250,000 up front, or you have the option to take that over 15 years. As for if it's already in place, that may be something you need to look at. Are you, is it in an appraisal? Are you doing a cost segregation study? Really, how can you show, my always biggest thing is how can you show the IRS the proof, right? Can you show that that work was done? Is it there? And what was the value of it?
Yep.
And
Yep.
Dave, sometimes what I notice, it's the timing. So if it's in place, it's immediate.
Mhm.
Whereas if you have a reserve, maybe you bought it in November and the tiling doesn't go in until March, you're going to have a year delay on that deduction. That's probably the biggest difference that I see at times.
You bet. That's helpful. And Liz and Paul, you both worked with us in getting into other cropping systems. Let's think about permanent crops in the PNW or in California. And certainly we have clients that are thinking about offsetting really high net incomes with acquisitions of permanent crop assets. Granted, there's many of them operating at a net loss
Yes.
lately. But let's think about the regionality, and let's take maybe an apple example in Washington, or a grape wine grape production example. We get quite a bit more available to us in those scenarios. You guys want to walk through that a little?
Yeah. Maybe Liz, I'll jump in on that because that's from my previous backyard. So yes, I mean, you may buy a apple orchard in Washington State for $30,000, $50,000, maybe $100,000 per acre, and maybe 10 to 15,000 of that is the actual land value, land cost. The other 25 to 75,000 is going to be trees, which is straight line over 10 years, but eligible for bonus. Section 179, you're going to be way over the limit, but you can write off 100% of the trees. You can write off 100% of the trellis, the irrigation system, everything but the land. And then on top of it, you can do a Section 180 allocation of the excess fertility. So, you're going to get, Tyler was talking about, you buy $6,000 acre and maybe you get a $1,500 deduction. Here you buy potentially $60,000 an acre and you get a $50,000 deduction up front. So it is a big deduction. Now, we won't go into all the details of passive activities, Dave. This is assuming that you meet those requirements, you are a farmer, or you have other passive income that you can use to offset the deduction.
Tyler, on that front, have you guys done some analysis on some orchards or vineyards, permanent crop systems?
Yeah, I was looking at the data actually today, and California, for example, is one of the higher states in terms of a state average. You've got your almonds, pistachios, and a lot of those permanent crops that are heavily fertilized because it's a super high value crop, right? So there's no skimping on that. Well, maybe right now they're skimping, but most years there's no skimping on that. So your fertility levels are pretty high. Like California, for example, I think is a state average of like $2,200 an acre. So comparable to Iowa farmland, it's quite a bit higher from a ratio standpoint.
Yeah, so the moral of the story is when we think about depreciation, it's a little bit of strategizing, right? And making sure you're taking a close look at what you've got and how to think about it, and working pretty close with the tax accountant. And Liz, you sort of walked through, but referencing back to our sort of simple Iowa 160 acre example that we're starting with, just to keep building on it. Let's say that we can capture that $1,500 an acre. It gives us a $240,000 of income offset, which stacks up another 12.5% of an offset relative to our initial basis, right? So we got that little over 14, we got another 12.5%. And the depreciation as we go into this white paper is going to be super interesting for us to sort out, because there's infinite permutations that we can exercise. And so we're going to have a fun time sort of thinking about how to zero that in some case studies. So appreciate that. Next one I want to dive into a little bit is the stepped up basis. And this comes back, obviously, Paul, to our same sort of active passive kinds of interests. And we've got that issue a little bit with family offices that are thinking about farmland as a generational wealth transfer. We've heard that thesis quite a bit. Hey, inflation hedge, non-correlation to public equities, and generational wealth transfer. Give us a little bit of a backdrop on how the stepped up basis works across the pretty basic in a standard farm family example, maybe a little more complicated over there.
Well, let's take your example of the 160-acre farm in Iowa, where your cost basis, you bought it, maybe let's round it to 2 million, just nice, easy numbers. And let's say that you own it for 10 years. I think that's an example we have. And in that 10-year period, it basically doubles. It goes up to $4 million of value. We get to step up no matter what we've depreciated. Let's say, hey, it was a combine, we brought it down to 0. Well, if it's now worth $4 million, we get to step it up to $4 million. And then we get to redepreciate whatever is eligible for depreciation. So tiling, we get to do another Section 180 report on the excess fertility. So tiling, fences, grain systems, buildings, any of that is going to be depreciable. Now, the one thing, since it is, quote, a related party, you're not eligible for taking bonus depreciation or Section 179 on that. So that will be amortized over, as Liz scheduled, the 20-year period, 7-year period, 15-year period, 10-year period for trees and so on. So it's a very powerful tool. That is also why we typically don't like to have appreciating assets in a corporation if we can help it. Because remember, that corporation gets stepped up, but the assets inside the corporation do not get stepped up. So we don't get to redepreciate that. So it's okay to have depreciating assets in the corporation and so on, but certainly land, other type of assets are going to appreciate. We want that outside of a corporate scenario, so to speak, so we can get that step up in basis.
How about limitations on passive landholders, right? Do we have caps on how much step up we can get if we're active
Nope.
versus passive?
No. The cap on active versus passive is just the ultimate deduction of it, but the actual step up is exactly the same whether it's active or passive. So you don't have to worry about that scenario.
So that does make it a pretty powerful tool. You know, just stacking this into our simple example again, where we grabbed our Section 180 at $1,700 an acre. We grabbed $1,500 an acre in tile depreciation, and then we run your scenario, Paul, where we're looking at 10-year ownership, get the step up in basis, assume that 7% annual appreciation rate. Iowa over the last 30 years has been closer to 8%, but assume that 7%. Assume a cap gains of 23.8.
Yep.
Is a fair assumption. We got $504,000 in cap gains tax that pops out, right? And so if we can step that up, we combine these things, and it's a little bit awkward, right? We're offsetting income in other cases. We got a direct tax, but we just combine them at an aggregate. You're actually at 53% of your original basis into that farm. I think the really interesting thing that happens here is that using these tools right are a pretty powerful opportunity for us.
Yeah. And even if you end up doing a 1031 exchange into other farmland, you're able to roll that over and you can take the deductions over again. Now, you may have a reduction because of the gain you rolled over, but you are eligible for then starting another deduction at that point.
You bet. Let's dive in to a couple other things that are emerging here. And 45Z, I know, Paul, I've seen you on a couple of webinars trying to sort out what happened in the one big beautiful bill on the 45Z tax credit. Can you give us just the real brief background of what 45Z is and then what happened?
Yeah, so the background, this was put into place starting effectively January 1st of this year of 2025. It was only going to be a 3-year credit. It's at the biofuel producer level. So it's not at the farm level, but the farmer can participate in that credit if they deliver what's called low carbon crops. It allows that producer to get about up to $1 per gallon credit. Now on a per bushel basis, because we're all used to bushels, that's almost roughly a $3 credit per bushel, potentially. Now, again, I think at the max that the farmer could ever participate in that is maybe 1/3 of it, so about $1 per bushel, but that's material these days. Now, they were supposed to have regulations, the Biden administration, him and Hod, and they finally got it issued, I think, on like around January 15th, so, but the big, beautiful bill actually extended that for another 2 years. So now it's effective through the end of 29. It also restricts the feedstock to North American feedstock. So corn, soybeans, canola, et cetera, has to be grown in Canada, Mexico, or the United States. Now, will China then slide in some used cooking oil through Mexico? Maybe, but that's beneficial. Also, the indirect land use. So especially for soybeans, because the fact your yield on soybeans is about 1/3 of the yield or 1/4 of the yield on corn, that was really restricting how much of a reduction you could get in that carbon intensity score. Well, that's been eliminated from the calculation, so that's beneficial. And then there's some other tweakages on it, but those are probably the three key changes. Now, again, this is a 5-year, well, actually 4 years, 26, 27, 28, 29, probably likely going to have to extend it. We're back on the extender train, so to speak, but this does give us some certainty, and it's going to allow those biofuel producers to make some more beneficial changes to how they score their, whether they do direct capture of carbon. That's the biggest bang, but certainly farmers such as Tyler or whoever it is that can deliver low CI score, they can deliver very low scoring corn, that produces a fairly good sized credit for that biofuel producer, who then is likely willing to share at least 1/3 of that with the farmer.
So Tyler's going to hear this and say, all right, I want to create some value. My non-organic corn, Tyler does a lot of organic, but my non-organic corn isn't worth very much these days. I'm going to go slap a bunch of cover crops out there. I'm going to back off and do no-till. Effectively, he has to be able to calculate his CI score, meet thresholds, and then be able to get a third-party audit, correct, on that
Correct.
CI
Now,
score?
typically what you're going to find out, I think the biofuel producer is likely going to sort of give the parameters for the farmer to meet. Yes, you'll have that third-party audit. Now, that may be paid for by the biofuel producer, if you can deliver that crop. So yes, you have to meet all those requirements. And the one USDA came out with again in January, sort of a calculator. You plug in what county you're in, whether you're doing cover crops, whether you're doing no-till or minimum till, and whether you're doing some type of enhanced nitrogen fertilizer application, and it'll calculate what that change in your CI score is.
And how do you anticipate these transactions actually flow? Is Tyler going to get paid when he delivers the crop? How do you actually see that working? And I'm sure that there's a little bit of uncertainty in that at this point.
Definitely uncertainty. I think part of it, people were hoping that you could get a certificate that you could actually transmit to a biofuel producer 1,000 miles away from you. So, well, we don't think that's happening, but I think there's two ways. Probably if you participate with that ethanol plant or the biodiesel plant, or whatever it might be, you're probably going to get an upfront payment, maybe to cover some of those costs. And then you'll get some type of a per bushel premium, 10 cents, 30 cents, 50 cents, whatever it might be.
Sure.
I just wanted to add one comment to that. We learned this the hard way a couple years on our farm, where we were extensively with cover crops because we were working on some premiums built into the organic farming system. And I see some parallels coming sometimes with the 45Z stuff. And what that is sometimes cover crops, well, we like what they do for us. They're long from being cheap. And so I'll give you a good example. In central Nebraska, we ended up having $30 in seed, and we had another probably 20 in operationally to do it. And then we had a super dry spring, and we had $70 an acre in irrigation after we terminated that cover crop, which was an extra herbicide pass, just to get our corn out of the ground. So if we're looking at 30 or 40, 50 cents a bushel, we already had $100 an acre in it. Hopefully to achieve that is something that is pretty opaque. So I don't want everybody to just be like, holy cow, guns ablazing, let's go plant cover crops on every acre, because it's going to be a big cash windfall. do your math and homework on that before you get too carried away, because you may find out that it costs you a lot more than what it's worth.
Yeah, and I actually did some analysis on, I picked my Dade County, Missouri, where my Missouri farm is. I picked Buchanan County, Iowa, and then I picked a county up in South Dakota. And your biggest bang is the farther south you go, the bigger the bang. You know, if you're, I think, you know, it was like for soybeans, like $2 savings potentially per bushel, $2 or $3 in Missouri, and in Iowa was like less than $1. So, you know, you're right. I think the biggest bang is probably no-till, you know, because that's probably a practice that maybe some farmers are already doing. You know, they don't have to change anything. It's no extra cost. That's probably the biggest bang, I think.
This is really important clarification on this. What we're talking about right now is farmer economics, right? And
Yep.
we're sort of bringing this up as a potential value add for landowners. To Tyler's point, and then kind of what you supplemented there, Paul, this may not be the windfall to the farmer that you think in terms of subsequently creating the windfall back to the landowner. We do want to help folks understand that as a broad sort of directional force in the market, we may have something here that can create a little bit more return to land, but it's not an immediate windfall the same way some of these other tax benefits that
you're probably looking at really another year or even 2 years before you really start seeing any benefit, in my opinion, any material benefit.
So one other interesting dynamic, and we've certainly worked with some funds that are dedicated focusing on this, as well as have some high net worth family office investors that are at least keeping an eye on it, and that's the opportunity zone opportunity. We kind of call it 2.0. We're still trying to get our arms wrapped around this. I know this group and Paul in particular, talking to you, don't quite have that all dissected yet. There's been quite a few changes that are coming through. Paul, do you want to give just the quick cliff notes of what the opportunity zone construct has been historically, and then maybe what we've heard a little bit about the 2.0?
Yeah, so essentially the original opportunity zone allow you to defer paying taxes on your capital gains till the end of 2026. It also allowed you to get a step up of 10 to 15% in bases if you held that opportunity zone for at least 5 or 7 years. And then maybe the more powerful benefit is if you held that opportunity zone for at least 10 years. Let's go back to your example of the farm in Iowa. Now, again, land, let's pretend like it's a building. Because typically land is not eligible. It's the building. But you invested $2 million in that building. You got to defer $2 million of capital gains that you didn't have to pay tax for, let's say, 7 years. And then if you held that building investment for at least 10 years, and that building went in value from $2 million up to, let's say, $5 million, that $3 million of appreciation, you got to get rid of that depreciation. So that was sort of the old rule. The new rules, again, don't have all the details. And actually, the IRS is going to have to write some details. The one big, beautiful bill, I think there's about 10 or 15 pages just dealing with opportunity zone. A lot of it is write the details. But if you invest in a rural opportunity zone, your bang for your buck is almost 3x. So I think that is really going to be potentially beneficial for, people that want to invest in an area that has an opportunity zone, and they're going to improve that land. They're going to put in a new storage grain system, or they're going to make some improvements, because the key is in order to really take advantage of that opportunity zone, you have to improve that property. Just buying farmland with nothing on it and never putting anything on it doesn't really gain you anything.
And so the opportunity zones were established in Trump 1, and it was turned over to the states to identify the zones, which there's a handful of formulaic approaches that they use, but generally speaking, it was areas that they wanted to target for investment. and
Yeah.
then in development, and then creating this tax benefit on the backside. And it looks like version 2.0, we're going to have to wait until, I've heard, like July of next year is.
I would say that'd be a year, probably. It'll take that long because again, there's a lot of extra details that really wasn't spelled out. They were hey, IRS, do this, do that. And I think what happened on Trump 1 is everybody was investing in like cities. It wasn't really going into the rural areas. It was going into cities where you get your biggest bang for your buck. So they're really trying to incentivize in Trump 2.0, let's call it, to really be in that rural area. So I think potentially it has a lot of value. And even I've had clients set up their own opportunity zones and it's worked pretty well. I think potentially we may see some farmers setting up opportunity zones to put in a new grain system, a new building, or a new hog barn, whatever it might be.
Yeah, so it's sort of a stay tuned on the opportunity zone side, and we'll kind of continue to feel that out. Maybe one quick trip back around on interesting things that we haven't covered that popped out in the big beautiful bill. Liz, is there anything that comes to mind that we haven't quite hit on, or structural things, general sort of income tax things that you think are interesting to share with the group?
Yeah, I mean, I think as I mentioned, earlier, bonus was the biggest thing everyone was watching for. Obviously, talking about tax depreciation back to 100%, right? I know that was a lot of concern for tax planning. Not knowing halfway through 2025, do I get 40% of my asset to depreciate in year 1, or do I get 100%? I mean, again, we could talk for the next 4 days just on this bill, but based on my topic, that's the biggest one that really pops out that people need to jump on now for tax planning and think about before year end, now that we all know.
Yeah. And I think another one that's important for farmers and family offices and whoever it might be is the fact that we now have a $15 million lifetime exemption permanent. No longer we have this bonus and base and all that nonsense. We have 15 million going forward. And I think on the farm bill side, I call it the farm bill side, we do have a bump in reference prices, and we're going to have more liquidity going into the farm economy a year from now. It's not immediate, but it'll be a year from now. And so potentially that helps farmers, which they may share some of that with their landowners.
Perfect. Tyler, do you have any closing thoughts for the group?
Well, I think Paul's point about that lifetime exemption moving up, the boomer age group in our country is not getting any younger, and that's really going to help a lot of families having that kind of big step up exemption going forward. But, I think there's still a lot of opportunities in agriculture. There's just some opportunities right now that are probably, you got to look a little bit harder to find them. And I think there's just a lot of tools out there that when you start to peel back layers and things of that nature, there's still dollars to be found in ag. It's just not it's not as easy as $6 and $7 corn to find those opportunities, but there are still a lot of things out there that can help guys strengthen that bottom line. And right now, I don't think any of us have the luxury in ag to be complacent. So we really have to really kind of dig under and work with people like Liz and Paul and Dave, folks like you guys that are really experts, and us on the fertility side. There's a lot of experts out there in a whole lot of different spaces. I don't think anybody's an expert on everything, but there's a lot of individual experts, and they really can help, I think, folks with planning and getting through some of these meager times that look like are on the horizon.
Well, thank you all very much for giving us a crash course and helping us walk through a little bit. Like I mentioned earlier, we are going to try and put this in a bit of a document that kind of spells out some of these case studies and hopefully adds a little bit more color and some additional reference points. And feel free to reach out to any of us with any additional questions, and very much look forward to kind of hearing from folks and figuring out how to help people with these tax advantages. Thanks much.
Thanks.
Thank you.
Thanks, everyone.